So hi guys, welcome back to today's video. So today's topic will be about unit trust and mutual fund versus ETFs. So I'm sure many of you would have heard about mutual funds or unit trust in Malaysia. So I will also be bringing up the topic about ETFs, where I'm sure it will be more commonly known in nowadays, where people feel that investing into ETFs are a good investment choice. So even people like Warren Buffett has been preaching about how investing in index ETFs is always the best type of investments that you can make. So today I'll be going over the differences between unit trust and mutual fund versus ETFs, as well as which is the better investment vehicle. So the first thing that you have to do is understand what mutual funds and unit trusts are, as well as what ETFs are. So mutual funds are essentially a pool of money collected from various individuals, and they are put into a fund where they are operated by professional fund managers. So each investor will then get a certain unit of that fund based on the amount that they have invested. These fund managers will then use that pool of fund to invest into different financial derivatives such as stocks, bonds, money market instruments, and other various financial instruments in order to generate capital gains. And these capital gains will then be allocated back to the individual investors based on the unit that they hold in that fund. So ETFs are similar, whereby it's also a pool of money gathered into a fund from various investors, and they will also, each individual investor will also get a certain unit on the share based on how much they invested. But the main difference here is that ETFs are not actively managed, unlike mutual funds and unit trust. Instead, it tracks and mirrors indices such as the S&P 500 as well as the KLCI. So if you buy into an ETF that tracks the S&P 500, such as the SPY, you are essentially buying into the top 500 companies in the US. So if the S&P 500 rises by 10%, your investment and capital gains rises by 10% as well. So that's the first major differences between the mutual fund and unit trust, as well as an ETF. So mutual funds are actively managed, whereas ETFs are passively managed. So the next difference is the management fees between the both of them. Due to the difference in how they are managed, the management fees charged are different as well. So mutual funds are actively managed, which is why the fees charged are usually higher, and it will usually be in the range of 1 to 2%. This fee will be directly credited from your investment portfolio, so you don't have to personally transfer the money to the agent or to the financial institution. ETFs, on the other hand, do not require much actions because they are passively invested, so the management fees are a lot cheaper as compared to mutual fund and unit trust, and it's usually around the 0.5% range. So there are many other ETFs that charges even lower, such as the S&P 500 ETF, which is the SPY, which I mentioned before. The management fee, which in ETFs is usually called expense ratio, is only 0.095%. So the third difference among them is the way that the asset or financial instruments are bought. So in a mutual fund, it's based on the net difference between the opening market price as well as the closing market price. So what this means is that when you buy into a mutual fund, you essentially have no idea what is the price of the stock that you're buying into, because you don't know when the fund manager is buying into it, and you only know your capital gains and how much you have earned at the end of the day when the market closes. So you'll only be able to make a decision whether to buy or sell your mutual fund based on your profit and loss on the previous day. Whereas as for ETF, because it's an exchange traded fund, so your funds are traded over an exchange, so you're able to buy and sell them at real-time prices. For a mutual fund, whereas you have to buy through an agent, a platform, or directly through the financial institution or fund management firm. When you buy into a mutual fund, there's also a transaction fee. So a transaction fee is usually around 1 to 5% if you invest into a mutual fund or unit trust. Whereas on an ETF, since you buy it over an exchange or platform, there is also still a transaction fee, but the transaction will be charged once when you buy and once when you sell. Whereas for mutual fund and unit trust, you're only charged when you buy and not when you sell. So usually transaction fee of ETFs are also a lot lower. They're usually about 0.3% or minimum of 10 ringgit in Malaysia. Which vehicle is better? Like I always said, there's no one best investment vehicle out there, but it really depends on your preferences, your personality, and your investment strategy, because each of them has their pros and cons. But for me personally, if I had to choose one to invest into, I would choose the ETF over the mutual fund or unit trust. This is mainly because due to the fees charged on ETFs are much lower, be it the management fees or the transaction fee, and also your return is not necessarily lower despite being a passively managed fund compared to an actively managed mutual fund or unit trust. So let's say if I invest 1,000 into a Malaysian ETF every month, the transaction fees paid might only be about 10 ringgit a month. That is not a lot as compared to how much usually a unit trust or mutual fund will charge. However, the truth is that Malaysian ETFs are not a popular thing because not many people invest into them, so there's not much demand and supply of it, which is why there's not many options available. And similarly, the transaction spread is on the higher side as well. So which is why personally I don't favor into that, and I invest into US ETFs as well, which grow at a faster rate as compared to the Malaysian market as well. So if you use Interactive Brokers, a huge brokerage platform, to purchase your US ETFs, the minimum transaction fee is only about $1. The other thing that you have to take note, however, is that since it's a foreign platform, you have to incur the transfer fee when you transfer the money over from your bank to the foreign bank. So usually it's a fee of about $20 to $25. So which is why for people with a smaller capital, I don't recommend them using a brokerage platform such as Interactive Brokers, but instead I think that you should choose a brokerage that's a lot friendlier and on the cheaper side, such as eToro, because eToro also does not have inactivity fees of Interactive Brokers, where it's about $10 a month. So if you invest into eToro, the spread is only 0.09%, and essentially you can use your credit card to make the transfer. So there's actually no extra transaction fee as well, and there's no account maintenance fee or any other various miscellaneous fees. And the only fee that you have to incur is when you withdraw, which has been reduced to only $5 per transaction. So I think that it's a very friendly platform for people with smaller capital to use eToro, because it's a rather friendly platform as well. So after being used to these low transaction fees of ETFs, I think that it's a lot pricier to invest into mutual funds and unit trusts, because it really does make a difference over time, despite being only a single-digit percentage difference. For example, let's say you invest in the SPY, which is the ETF that tracks the S&P 500, the expense ratio is only 0.095%. If you invest into QQQ, ETF that targets mainly technology stocks, the expense ratio is only 0.2% as well. Whereas let's say you're interested in China stocks, the major China stocks ETF is called the FXI, which the expense ratio is also only 0.74%. So the return of actively managed funds might also not be higher than the passively managed funds, because very few fund managers or investors are able to consistently outperform the index. So which is why even Warren Buffett issued a challenge to any investor that can consistently outperform the S&P 500 to sort of use it as a challenge, and so far nobody has managed to consistently defeat the S&P 500 over time. If you are paying a higher management fee and a higher transaction fee, yet you are not able to generate a return higher than passively managed index ETFs, then what is the point of investing into such funds? But at the end of the day, there are definitely pros and cons to each, and this is just my personal opinion. Just have to understand that no matter which investment vehicle you invest into, the most important thing is to be consistent and adhere to dollar cost averaging, where you consistently take out amount of savings every month and invest into the financial vehicle that you prefer, and stay disciplined to your budgeting and investment plans. So with that being said, we have come to the end of the video. So please do leave a like and subscribe to our channel for more similar videos like this, and please do leave a comment down below for any upcoming videos that you wish for me to talk about. So thank you all for watching, and see you all in the next video. Bye bye.